most of the things I will show here come from a paper we published this summer earlier in partnership with the UNEP Inquiry and CDC Climat Research with the support of the French Ministry of Environment and the European Investment Bank. So it's a kind of global panorama of how carbon risks are assessed and which are the approaches that can be used to assess that at the financial level. And I will try to bring some other new things that you haven't heard before, but it's a kind of a good complement to what has been said earlier. So I think the first question that we can ask in terms of carbon risk in the financial system is whether those carbon risks are already assessed by existing modeling schemes, risk models, valuation models, and by extension, if they are already priced by the market. So if yes, it seems like a lot of people are asking questions about that, but if yes, it means clearly that we are facing a relative weakness of policies because the price signals are still very weak. So, but it could be possible. And the other option, if no, it means that markets are somehow failing to assess these risks. And that's the question I will focus on here, is why financial markets may misassess these risks and what are the specificities of carbon risks so that it raises a potential market failure. And so it deals also with the rational exuberance and apathy. Just, I won't go into the detail on that, but I think it's important in the pedagogy, in a way we talk with investors, especially those who discover the thing, to organize the difference between climate change risk into physical risks and carbon risk coming from regulation, from social reputational issues, from markets, from policy, regulation, etc., and physical risk. So we are more focusing on carbon risk because it's more material, if it is, than physical risk for investors. And as we've seen, it's not that material in their mind, but it's worth for physical risk. So the underlying logic behind this is what we call the diffusion, the spreading of carbon risk in the financial chain. And it comes from physical assets, where the climate goals and policies are striking. Probably the most important policies are industrial policies so far. And so it can affect the economy through value creation and value destruction. And from there, it comes from the physical asset side to the financial sphere through the financial performance and the risk of financial assets. And it can propagate to the portfolio and institutional level, and maybe at systemic level and potential systemic risk, which is the question which is quite new, but we will come back to that. I will maybe come back to that later if I have time, so let me quickly hit that. So, are carbon risk already assessed? If you want to say yes, what you can have in mind that there are some response of stock price and some publications start to highlight this. And in terms of behaviors or practices, we can see a lot of resources, more and more resources from financial institutions dedicated to climate, but to ESG in general. And so we can imagine that after investing in the last decade on ESG tools, database, etc., some information can get out of that and can be informative enough for them. And the question is, are the risk material today? And so, yeah, it's not like provocative to say that yes, it's already well assessed. It's just maybe that the risk is not material, so they are not concerned, and they believe it's somebody else's problem, and it will be maybe a problem in 5 or 10 years, but it's too long for them. So there's a huge time horizon question. We'll be back to that. And of course, but we already talked about that, the reason why it could be not assessed is the fact that we all believe probably in the room that there's a strong discrepancy between the behavior of markets today, with the exception of some sectors and subsectors, like we call, Mark mentioned several times, and the issues at stake and the global challenges that we are facing. So we'll be back to that, and our agnostic position when we look at that is perhaps we don't really know, but we want to see what would be the reason for which it could not be the case. And that's mainly how we map the problem in terms of economic theories. I won't go in too much in the details. I hope we will finish our paper so that you can read the economic rationalism like that, but it's clearly a kind of questioning of the efficient market theory, of course. And it's based on, let's say, 5 big factors that we will link to climate change. So the first one is what is called bounded rationality. It's kind of, it's quite simple. It's just that the economy and let's say life on Earth and climate in general and the nature systems are very complex. And do we take rational decisions in front of that? Probably not, because we as human beings and economic agents are kind of rational, but in a simplified model. And this simplified model is not optimal to reflect the reality. So that's the first, I would say, economic concept that we can push forward to say, okay, maybe markets are not efficient for that. It's the case for almost any economic question and social question, but it's even maybe more the case for climate change and other things. The other point is the question of time-inconsistent preferences. So clearly, and I will talk a lot about that, the question of time horizons is really major. So, of course, when we talk about climate change risk, and the vast majority of big impacts are still not very material, and even for carbon risk and carbon regulation, it can be tomorrow, it can be after tomorrow, but today it's still not very the case. So it's still a long-term issue, whereas most of economic and financial decisions are driven by very short-term issues. And we will, if I have time, come back to this question of time horizons in the investment chain. The other point is about is about risk and uncertainty. So we also already talked about that today, but for the financial markets to work well and financial models to be efficient, we need to have a good understanding of the risk and in terms of probabilities. And when it comes to climate change, either on the physical aspect and the different options and the uncertainty of climate modeling is something, but also the uncertainty of the policy decision on that. It's already a big uncertainty, a big casino, and it's very difficult to put probabilities on that. And so if you try to take this and put that into risk models, it's not easy. So that's why one of the reasons for which you don't have this conversation with most risk managers. So you do have that with experts of sectors, so that's what Mark again is mentioning, but you don't have this discussion with risk managers because it's not their vocabulary, it's not their distribution of the world, the probabilistic distribution of the world, I would say. So that's a big obstacle for an efficient market, I would say. The other one is about the question of individuals versus institutions, and somehow the misalignments of interests in the whole chain. Because all the economic theory builds on economic agents who are rational for their institution to behave rationally, and then to make some rational decision for the whole society and even the human beings and the planet. And the upper you go in the chain, in the human chain, I would say, it doesn't work much because interests are not aligned. And this is a big obstacle as well for markets to work efficiently. And the last one is about inefficiencies of information. So we already talked about that, and it's a mix of all here. The main thing being that externalities being not priced, and then when we try to price that through a price of carbon, clearly it's not representative of the whole externality, so it cannot work. So the sum of all these individual, I would say, failures can bring an overall market failure and bring carbon risk to be totally missed assets, or potentially, or not well assessed. I will come back a little bit on some of the parameters I mentioned with this question of the risk manager trying to put risk into his models. So risk and uncertainty, we already described it a little bit. But clearly, when I think when the risk manager in a financial institution, in the bank, for instance, open an IPCC report and see all the potential scenarios and the wide difference between what is possible, not even what is not in scientific mind, I think he cannot even try to work with that. He close the book and go back to his 1 year time horizon. So it's very difficult to work on that with the existing model concepts. And another very important thing, even if it looks quite technical, is the question of the data. Because most of modeling schemes are based on statistics and the existence of data representing past shocks, past crises. And you build on this past crisis and behaviors of your portfolios and your assets to try to stress test your current assets and stress test them. And so finally, when you don't have real data of what could happen as a kind of historic understanding of what can happen, it's impossible to feed many of the models because, yeah, it's just a new thing. And climate disruption at the human scale is a new thing, and so you don't have economic data, you don't have the value, the effect and the value of a stock about that. Even if some car makers experience some kind of policy risk these days. But yeah, we're building the first data, so it's not enough to build series of historical data and build new scenarios for stress testing, for instance. So there's the question of distribution, which is even more technical, but we talked a little bit about it already, about what is the Gaussian distribution of risk that we would like to have in a usual model. When we talk about climate scenarios, what is the center of the distribution, and what represents the potential fat days in terms of global objectives, 2 degrees or 3 degrees, whatever. And finally, my main point here, and it's also very central in everything we do and we publish since we built the organization 3 years ago, it's a question of time horizons. Clearly, the whole investment chain, whatever the businesses, the products, you have a question of time horizons and a big discrepancy between what is at stake and the financial decision. So when you deal with physical assets, the discrepancy is not that big. That's why in companies, the knowledge of climate change is not that bad. I mean, a lot of people invest resources and have models and know what's going to happen to their heating or cooling facilities, for instance, for power plants. But when it comes to the investors or the banks who lend money for 2 years or 5 years to these companies, it's much less profitable. And so the discrepancy between time horizon of, I would say, physical assets and financial assets is sometimes that big that just the question is not even raised. It's not a question because it's not my business, it's too far, it's not in my radar. And so all this together may lead to a kind of market misread where everybody acknowledges that there is a risk, a potential risk that will come somehow, sometime, but when, we don't know, and so far today it's not influencing my decision. And so most of the decision is not really influenced, whatever some people may say, it seems like it's not really the case. So that's how we depict the global thing. I don't know how many 3 minutes, I will try to go fast in the end. So I invite you to read the paper that we released in July to see all the details, but what we did is make a panorama of all the approaches, trying to compensate the fact that the market may be inefficient for that, build new tools, new approaches to identify, assess, and quantify the risk. And so it comes from physical assets to systemic, systemic level, bottom-up approaches at physical and security level, and some more top-down approaches for portfolios, for institutions, and for a global level. That's where we start. So I won't go in the details here, but you have a lot of different approaches that are now existing, and you have many publications that are made public, and many more that are not public because it's directly the products of brokers or asset managers working on that. But you have different levels to focus on the carbon risk for financial institutions. I'm trying to mention what I will skip from now. So maybe the details of the different approaches, but what is maybe important to have as a global conclusion on that is that when you go from the bottom of the chain at physical asset level and go through the financial system, you see that it's pretty clear, and now people really understand the impact, potential impact of carbon risk at the physical asset level. Throughout the financial system, it goes weaker and weaker, and finally, nobody really knows what's going on at systemic level. But the interesting point is that it is really now what is being raised, especially by policymakers. So we already talked a little bit about the Bank of England. More recently, but everything is very recent here, the FSB, which now has to work on the topic as a question raised by the G20. And even more recently, because it was passed, this summer, the French law on energy transition has now something in its 200 and something articles, one article dedicated to finance sector and to investors, especially, to express how to deal with this question of climate change, how they will report on their risk, how they will finance the energy transition. And now it's compulsory in the law. It's in France, it's starting, but at least it's one example. And a lot of attention is being made, especially 2 months before the COP. Oh, maybe there's something linked between these two decisions. But it's very important because everybody is looking for what is going to happen there, and if that regulation will make a difference. So we are clearly at a turning point. We've seen significant steps in integrating this carbon risk in risk and valuation model. It's starting, it's not widely diffused, but it's starting. It has started already, actually, but it's starting to be a bit more mainstream. But the question is about the short-term materiality of this risk. And probably it's the next question to be answered. If you come back with the proof of materiality, it will be probably much embedded in valuations and the prices of assets. So some practitioners are really ready to investigate and implement new approaches. That's what we see in what happens these days. And the two reasons for that are intuitive. Some really believe something will happen one day, so they have to be ready because it's their business and they just want to anticipate a little bit the market. And the other one anticipate regulation. And actually they didn't anticipate that much, at least from a French perspective, because it's not the future, it's starting now. And I will leave you with some quotes of what has been said just from 1 year from now. It started with 1 year ago with the Bank of England, even if it started a bit earlier. But it's no more science fiction, you are at the turning point. So thank you very much, and please also notice that we are a member-based organization, so you can join us as a member, whether you are an individual or an organization. But yeah, I will leave you with the quotes.